You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
I want to give a special thanks out for our sponsors and the U.S. Option Exchanges for your support of the Options Industry Conference. And also thank you to the conference team, Tricia Pearl and Jen Hopkins, who put this event together for us. Let's give them a round of applause. I also want to thank the production crew on the risers behind you, back over here, and also behind the stage, and Freeman for being here with us. Thank you so much for doing such a great job with production. And I especially want to thank each and every one of you for being here with us and participating with us over the last few days. Now, you're going to be getting a survey on the conference after the event. Please fill it out because we use your feedback to create next year's conference to make it better and better in just the way you want it. So please give us that feedback. Now, as we bring the conference to a close, it's time to break out the crystal ball and see what's next. Joining us is an esteemed group of industry panelists who will provide their market insights and predictions for the year ahead. Help me welcome our moderator, Kaitlin Meyer, Vice President, Marketing and Sales at MIAX, along with their panelists, Shawn Cruz from TD Ameritrade, Tom Martin from Dash, and Patrick Zielinski from Box Options.
First and foremost, I just want to thank the OIC for a tremendous conference. I know for me personally, it's been great to see a lot of faces over the last few days. Great to have all of you that have stuck around until the end. You know, over the last few days, we've had a lot of insightful panels, conversations I think we've all had, you know, talking about trends, growth, challenges we're seeing in the industry. You know, as we close this out with the market outlook, we're going to talk about some of those and get their perspectives on what's ahead. So feel free to ask questions throughout. To close this out, let's make this conversational. I'm going to end with a few rapid questions for you guys. So with that, if you wouldn't mind taking a few minutes, giving a little intro on yourself, and then we'll get started.
Yeah, so I'm at TD Ameritrade, and I'm in the Trader and Education Group, and I think it's an interesting place to be right now. We've heard a lot about new participants. They're coming in, they're driving this volume higher, and then it's a matter of how we at an industry not only have the front-end tools, the platforms, everything, the service to handle that, but then we're also thinking about, on the risk side, how to do that. And sometimes the way to get ahead of the risk picture is actually through the education, where clients actually learn to manage their own risk better, and then it's not on us to go out there and have to deal with that for them. So it's an interesting place to be at TD Ameritrade, going through the integration with Schwab and getting some insight into two very large retail groups in this industry through the past few years in particular, to see how things have evolved and how we can respond to the industry. And we've learned things along the way that we do well. I mean, we've learned things along the way that we need to shore up a little bit, and it's something that is continuing to be an ongoing process as I think the market right now is evolving.
Thanks, Shawn. Tom Martin, co-head of the options business at Dash Financial, and I focus on a daily basis on options execution, product strategy, functional market microstructure, and a Dash OMS suite of products. And at Dash, we really focus on being an institutional agency-only broker-dealer, providing transparency into the marketplace. I'm excited to be up here.
Patrick Zielinski. I'm the interim CEO of Box Market, and it's a pleasure to be here, and look forward to our discussion.
Great. We're going to start at a high level. It's been touched on quite a few times over the last few days. The increased volatility we're seeing, heightened inflation, geopolitical concerns that aren't going away. Margaret Brennan touched on it yesterday. I think one of the CBS polls was the number one concern people are, worried about is inflation. So how is that impacting demand, each of your perspectives on the client segments?
Yeah, I think, in the past in the market, one thing I would say was people should know they should be worried about something, but they don't know what that something is. So I guess we now know what that something is. It is inflation, but it's evolving. And if you think about how perceptions from the market have evolved, if you look back to last December, the market was pretty much centered on inflation peaking out in January. The Fed was going to do 2 to 3 25 basis points hikes throughout the year. And then, I attribute a lot of this market volatility to one single event, and that was Bullard in January coming out and saying, hey, we're going to be a lot more aggressive than I think the market is ready for. Inflation didn't peak out in January, and we went from thinking about 2 or 3 hikes to now, I think at one point it's like 7 or 8 or 9. And is it going to be 50 basis points? Is it going to be 75 basis points? And if you go out and look at market perceptions, you can almost see that change week to week, month to month, where the market is moving around. So I think there's this, they know what to focus on, and they're focused on this inflation outlook, but inflation is kind of all over the place. We thought we were going to hit peak inflation, and things were really going to drastically pull back in the past month or two, and we're not necessarily seeing that. We got that from the CPI print, and if you looked at what the futures market was doing, it was actually up a little over 1%. And the CPI print came down, and it came crashing. It came out, and it came crashing down to flat to slightly negative. And then you get the PPI number out today, and if you're looking at profitability of companies, there's a very tight relationship between the spread between CPI and PPI and predicting profitability for companies across the board. That print came out today a little hot too. So as long as that is in flight and we just really don't know what's going to happen, the Fed can't control China doing COVID lockdowns. They certainly can't control what Putin's going to do. As long as all that is in flight, the Fed is kind of not in the driver's seat for what is pushing inflation right now. And that is just going to drive uncertainty. And then I think the following that is just volatility in the market.
Patrick, let's go
just to echo off of that, right? So I think with increased inflation, the ongoing conflict in Ukraine, these are all external forces that are going to drive markets, right? So when you look at demand at least from an exchange operator point of view, there's a demand on messaging capacity of systems, right? So on an everyday basis, it's just, capacity is it's not an unlimited resource, right? It's a scarce resource. So although the volume trends might, peak out, it seems like things are normalizing itself in the industry at that 40 million ADV level. I'm sure with the extra market volatility, we're going to see ups and downs. But regardless of what the volume is, it just seems like we're at record messaging, right? Also on the exchange side, I think that the extra demand in just resources themselves, like operational resources. It's not only the front end of the business, it's the back end. Do we have the resources and the technology in place and the infrastructure to handle, all the increase in the institutional demand, right? So it's the post-trade allocation tool. It's just ensuring that the client experience and their needs are being met in any market condition, but certainly it's more exacerbated when you see these market fluctuations. But in particular, the thing that is most interesting, I think, is considering what's going to happen to the financial system itself and the impact of liquidity as we go from a loose monetary policy to tightening, right? What's going to happen to liquidity? There's going to be some, excessive demand, but will the supply decrease as part of that? And what does that mean for the options marketplace?
And I think we were talking about that earlier, where it's like we're used to liquidity being supplied by the Fed, and right now, unfortunately, liquidity is being supplied by the market through liquidations, which is still that key operative word. And I think that is what's happening right now is the Fed stepping back, not providing that liquidity, and you're seeing some liquidations being provided by the market right now.
Yeah, I think one thing that's interesting on our side, given the increase in volatility, which generally drives a wider market on the screen, right, is that the institutional side is looking for alternative paths to sourcing liquidity. And one thing that we've seen as a trend is an increase in interest in RFQ styles of platforms. And in that platform, you have the opportunity to find additional liquidity, yes, but then potential price improvement as well. And so one thing that we've been trying to do to solve that for our institutional clients through our ATS is really provide a path to source that liquidity off the screen, but still bring it to the screen in the options market. And we've seen success in that model so far, and something that we've continued to focus on.
Yeah, thank you guys. Let's get into some of the questions, that were touched on this week. Efficiency, doing more with less. People want simplicity, often in one place. So what is the type of demand that is being placed on the downstream ecosystem? Tom, I think this is one that you wanted to touch on.
Yeah, I think, where we sit in the ecosystem, kind of as the downstream provider in the middle a little bit, is we see increased demand to be able to do more with less. And we've seen that in a couple of different ways. And firstly, we'll start on the front-end trading system side. I think it's a trend that's been going on for a while, but if you take a look at front-end trading systems, some desks have 3, 4, 5. I've seen 9 on an individual desk, which is crazy, but you've seen that come in a little bit. And really what we're being asked to do is more with less, meaning trim that down to 1 or 2 systems, be able to handle front to back office workflows within a single system across multiple asset classes. And that's tremendously difficult whether you're a big or small OMS provider. And if Ravi was here, he would probably like to join in on that. But so we're seeing it on the front end side in terms of consolidation to be able to bring everything in, support it in one spot. One thing that we focused on in order to help with that in our Dash OMS product is providing an intuitive and seamless platform for your options trading, but making it highly integratable within your ecosystem to kind of ease some of that transition from swivel, like pivoting, right? And then on the second side is really on the options execution side. And on a trade desk, you see fewer people, so they're being asked to do more with less, and you really see an increased demand in longer duration order types. And over the life cycle of that order, you're really going to encounter difficult market conditions potentially, and as well as complicated functional microstructure. So we've taken the approach where we sit and listen to our clients and say, hey, how can we make your lives easier to design this one-click style of tool where you can put something in, set it, and forget it, and move on, but what's important is you need to drive an optimal outcome for the user or the operator, but as well as the end client. So those are kind of some of the ways that we're seeing an increased demand downstream.
That's great. Shawn, what's your thought? From a retail perspective, a lot's going mobile, but again, that one click of a button.
It is, and we see a lot, and I would say just the bulk of where we're seeing clients interact with us is actually through some of these mobile platforms. The way things have evolved, and it actually, that's why I always go back to just the January turn in sentiment. And we've seen it if you look at the OCC data when they report out where they're seeing volumes go up or down. Single name volumes are actually down, and we're actually seeing that in our client base as well. Where they're not going in and going after a lot of these single names. They're actually going into more of the ETF and index type products and not being quite as aggressive when they do go into those spots. And I think for us now it is becoming more of a way of being able to service those clients when they're looking at this uncertain outlook that we have. They're actually contacting us more for not necessarily trade specific related, hey, I'm trying to get this order done, or what should I do on this order. They're more just calling us and just trying to get a sense for what's going on with their overall portfolio. And I'm interested to see how things develop moving forward and going into the end of the year, because I think if you fast forward December, we'll be having an entirely different conversation about what we're seeing out of the client base. Once we get this selling flushed out, do we start to see people going back into single names? To your point about the durations, we're also seeing that as well. We're on our weekly volumes. We're seeing that come in a little bit, and they're going out to more of this just longer run hedging strategy that they've been using quite a bit.
Patrick, did you have anything to add?
I just have a different context on the simplicity side because you guys are with the trade origination and all the things that go into making the trading decision, right? So I just view simplicity from, by the time we want to be a simplistic exchange, right? So the way that our architecture works, the way that our protocols are designed, and any little efficiency that provides the most transparency and efficiency and determinism into the market, that's just something that, we're doing less with. We're kind of just taking the waste out of our ecosystem and just focusing on, processing those messages in sequence as best as possible. So with that, it contributes to building and liquidity and enhancing customer executions.
Yeah, efficiency is key. We saw that in COVID of everyone having the transition and do a lot. We touched on the resiliency of the industry infrastructure. Unprecedented activity that we've all seen. As the markets have kind of taken a step back, what are you guys going to focus on as you think about future challenges?
Just in terms of resiliency, I think it's been the same theme for the last 12 to 18 months of how resilient the industry really is when you consider all the things that's happened in the last couple of years in terms of capacity and performance and just, from the SIP to if you back up even to like the retail platforms, all the investments that are made there to educate and draw in, the customer demand, that information needs to be distributed. There needs to be resources allocated to that and planning that's done. In addition to maintaining the critical components of the industry, like I said, the Opera SIP and OCC, the exchanges. It's kind of been like a highlight, in my opinion, of Reg SCI. It kind of makes these entities take a focused look at resiliency and making sure that we're making the appropriate investments in terms of capacity and performance. So I think in general, it's just enhancing the customer experience by creating a solid product because operationally we're able to handle these. We're there when people need it, right, in terms of messaging and processing data.
I think on your side, Avi said it best, right? It shouldn't be a surprise. It should be a 1, 3, 5 year planning process where you're looking at capacity and utilization and what are you forecasting? Now, can anybody predict the pandemic and the volumes that have come? Maybe not. But if you're planning well, right, then you won't be caught off guard in terms of capacity utilization and throughput. It's something that we spend a tremendous amount of time on, making sure that we're there to stand up our product when clients need it and making sure that it's resilient for the volume that we have.
Yeah, it's the forward planning, it's the thought to do that, to make the capital investments and stage things appropriately so you can hit your business targets. And then it's the analysis of how you're performing on a daily basis, the daily dashboards, the monthly reviews, quarterly reviews, and staging things in that portfolio. But then it's the day-to-day, too. It's the behind-the-scenes that people don't see, right? It's the network engineers, it's the sysadmins, it's the information security professionals. It's all these people that go into, providing and, support for the infrastructure. To me, they're really the secret sauce.
Yeah, and I think we've seen this, coming up, starting at Thinkorswim, going to TD Ameritrade, now we're going to Schwab. But, in the early days at Thinkorswim, we were always trying to come out with a new flashy module or, some new feature. And in the years leading up, and I think everyone can recall, if you look back like 2015, to 2018 or so, there were a number of massive volume days, particularly when we were going through a lot of the back and forth with China and everything on the tariff front. There were some massive volume days where things were getting jammed up, and we didn't really have, if you look back at like our release notes, there's nothing really cool that we did because we were singularly focused on platform stability. And we invested a lot of time in that. The other thing we did on the hiring front was we invested a lot in our risk teams and our trade desk teams to shore those up to handle that. So we didn't have the flashy front end things that were going on, but we were really looking at back end things. And I think that was an advantage for companies, to your point, that they were a little bit more forward thinking on that. So when all of a sudden, a once in a century pandemic comes along and volumes go through the roof, the industry across the board handled it incredibly well. And not only were on our side was it handled well, but think about the New York Stock Exchange going from that floor-based model to now completely remote, and they were still able to get out there, provide liquidity. The liquidity providers, the wholesalers, were still there ready to stand behind markets. It was incredible, and I think it's interesting now. Normally, if you told me we would see a VIX around 30, that's when we see client volumes, client interactions go through the roof, and we're actually not seeing that right now. So I think as long as volumes don't go through some of those pandemic March 2020, April 2020 peaks, the overall industry is well positioned for whatever is to come. We're ready. We're not at the capacity peaks that we hit, and we were able to work our way through.
Yeah, even with the volumes where they are, it's there's just things that are kind of like on this fixed level now, to where like the baseline for messages and throughput, it's increasing. So that's certainly the trend ongoing for,
as long as the
rest of the year.
exchanges don't add Monday and Wednesday expiration.
Well, we're talking about expanding and investing. It's been hit on a few times, 24/5, how the investment that's going to need to be made there, resources. But there's, I think, demand for it. So just getting each of your perspectives and what you're hearing.
I think from our perspective, adopting and being ready for the overnight session expansion, right? Whether it's the 8:15 to the 9:15 the next day or the curb session that recently went live, is something that we took tremendous pride in and did earlier. But it was operationally very different, right? You went from your core session, 9:30 to 4:15, to basically moving to a 24/6 operating model. Which in some ways is good for what we're seeing with some of the crypto trends. Obviously, in a 24/7 marketplace, does that?
I was going to bring up crypto. Yeah.
Our marketplace. Yeah, we didn't get far enough for crypto yet. So, but what I think is important to remember, and it's certainly something that we focus on, is that our business is multidimensional and multifaceted. And in order for this to be successful for the end client, whoever that may be, we really need to focus on making sure that the exchange is certainly ready, but that the routing broker is capable, that the OCC is ready, and then that its clearing members are ready to function in full. And I think once we solve that problem completely, then we'll have the opportunity to drive the value that we're looking to drive for the end client. So we're almost there, and I'm excited to see where we go.
I think it's potentially case by case. Maybe it belongs to certain products and maybe not. Single names across the board. I mean, I think there needs to be discussion on how does that look across the board with liquidity providers, ultimately if there's demand or not as well.
And I think it's a good point because we've had some discussions around SPX trading around the clock, and it's the only people to us who would be trading that at 1 a.m. They would probably rather be in that futures market. And
right.
We offer the
it's not retail.
ETFs.
Right.
Yeah, we offer ETFs right now for 24/5, and there have been some discussions. Well, should we offer the real popular names, Amazon, Apple, Tesla, whatever? Should we start rolling that out to certain single names? But it becomes a little bit of a challenge in that we almost as an industry need to be on the same page across the board. Because if one, let's say if Fidelity decides to make a move and start listing Amazon overnight, then we kind of have to do it too. And then we have to plan capacity around that. We have to be ready to monitor that in the risk front, client service front, and maybe you end up being 100% of the open interest on any, or the 100% of the volume or anything on any given name. It could present some challenges.
So real quick, you touched on single stocks. There's been new products, smaller contracts. As we looked at, Henry did an awesome job, of course, with his slides, and you see that hockey stick growth. Is that what retail needs to continue to grow? How is that sustainable? Is it offering smaller contracts?
I think from a volume standpoint, and we have recently done a lot of deep analytical work into what's going on with our client base. I think we have enough people in the tent right now, and so you say, well, where does the volume growth come from? Where, what are we going to do next? The one thing we notice about our client base is they come in and they're just doing single orders. They're buying a call. That's instead of buying 100 shares, I can buy one call contract. That makes sense logically, but as our clients age in terms of their longevity with the firm, they start migrating more and more of their activity goes into complex products, or complex spreads, I should say. So when we see that, it's okay, how do we educate them on the appropriate use of call spreads, time spreads, whatever that might be. We put a lot of investment into that because, one, those usually end up being more sustainable clients in the long run, and I think that is where you can get that volume growth where it almost doubles, right? If instead of buying a call, I sell a put spread. Now, instead of doing one contract, I'm doing two. It's risk defined, so for us from a risk standpoint, it's kind of preferable. So we kind of know exactly where the risk is in the book, even at a tail event or whatever it might be. I think that is where we continue to put a lot of effort into on the education front. I think that is a unappreciated source of growth for the industry.
Yeah, I think in terms of, firstly, education can't be overstated enough and how important it is. And on the institutional side, it's something that we spend a tremendous amount of time on. And it's whether understanding the asset class, yeah, that's one thing. But once I'm in the asset class, how does the ecosystem behave? How do these tools behave? What can I do? Can I do this electronically or does it need to be manual? So it's a tremendous amount of time for us. And I thought one thing was interesting that Greg Ferrari said the other day in terms of the weekly expansion on names that don't have weeklies, right? And when you look at strike proliferation, right, can we make an ecosystem that has the ability to add the products or things that we want to add but not burden liquidity providers that are in the business? So I'm excited to see where we go on that, but education is a daily focus, and I think the better educated, the more comfortable people become, the better we see to drive growth in the industry.
And I think the single name weekly discussion is something where, I think someone said, like, do we want the market to decide what is traded on a weekly basis? But that's a problem if, like I said, I was just talking about volume in general, but like if you're 100% of the open interest on a 30 delta strike, wherever that is, that's a risk problem for you. If you do have to, and for the client, it could end up being a bad experience if, hey, sorry, you're 100% of the open interest, and our risk models actually do control for that, so we're blowing you out on Thursday. And that's not a good discussion. I've had them. Not good discussions. They're not happy to talk to me. But it's something to think about at the industry. And like I said, it might be something out of our control if another firm has a client with $100 million and says, I'm going to another firm if you don't get me this. And they're like, all right, we'll do it. But then everyone kind of has to honor and respect any other volume in open issues that'll come through that.
Yeah.
And we can't get through the last session without talking about crypto, and Tommy, you already brought it up. So, Patrick, I'm going to start with you, but how does the evolution of crypto play into the options market, and what can we learn from it? I think 24/7 has been brought up, but what's your
so
thought?
crypto, it's a few different angles on that. There's a distinction between like the currency aspect and then just the technology that powers it, right? So obviously leveraging new technologies is always creating innovation, so it's an interesting thing to consider in our industry. Just from a commercial point of view, is crypto eventually going to compete? Like when you look at the demographic of who's trading crypto in options, there could be some overlap. So, could crypto itself as an asset class compete against equity options in terms of usability, right? So, it's just things that we need to consider and focus on.
Yeah, I think from our perspective as a technology provider, right, that sits in the middle, the parallel is, like I said, if it's a 24/7 ecosystem and the client demands that continuous trading session, given the infrastructure that's been built out with the extended hours, we're pretty close to having that ecosystem already. So perhaps we see a continuous session on the option side.
And I think the one thing is it matters where you're at in the space. So a lot of the brokerages that are out there that are going into or trying to go into the crypto space to some extent or another, it's a little different. The really big players out there, and you can think of E-Trade, I would lump in this as well, but we have Federal Reserve oversight on our business, which is a complete game changer when you're trying to go out into a space. So are we going to, when you think of everything we have going on, are we going to put a lot of resources and a lot of our development effort into a game we don't even know the rules for yet? And so if you're thinking about an outlook and something we're looking ahead to internally at our firm, it is when are we going to get some rules that we can think about? We know there's interest there. We see that as something that eventually will become a part of the discussion. We need to know the rules first. And then it's, how are these things going to trade? Can we treat it like, we think about like, we go from Apple options, and you can buy calls, sell calls in Apple, to like crude oil futures. You can sell call spreads and options on those futures. And so there's a little bit of a transferable concept behind that. We don't really know, one, what the rules are going to be, and then how is the best way on the front end for us to present that to clients in a way that they will understand what they're doing. And I don't know, personally myself, if the skills I have from options trading will transfer directly into trading crypto or not. And for us, we really put a lot of value around education. Then do we need to go out and find an entirely new class of associates that we have to hire in that we can build education on crypto around? So, but none of that can happen until we know what those rules are. And let's hope we get something this year. Then we can come together as an industry, and maybe at the next OIC conference, we are talking about how we're progressing and how we're building out that crypto trading capability.
It's always going to come back to education at some point, I think.
Yeah.
As we continue to look ahead, I'd love each of your perspectives. How is this industry going to continue to grow?
Yeah, I think certainly we've touched on all the points, right? It's adding simplicity to the product offering that includes just all the technology on the front end of the things to generate the business. Obviously the institutional demand, whatever we can bring from OTC markets into the transparent marketplace, and provide value and service that order flow as best as possible. I think those are really the two main aspects of, and of course supporting retail and continuing to ensure that, the equity options product itself is a great experience for them. So we get that reoccurring, especially if they're trading weeklies all the time, right? It's reoccurring transactions, and that keeps the wheel of growth turning, right?
Yeah, I think on our side that what we're seeing that we're super excited about is really an increased interest in Europe and Asia inbound, right? Obviously their market structure is quite different than our market structure. So as the world is opening up and people are allowing us into their office to educate, I think we'll see inbound flow from those regions, and having the extended trading hours session, right, that's available for someone that sits there in that time zone. Once we get the ecosystem correct, I think we'll see potentially increased growth in those segments. And then I think the weekly opportunity is interesting. Again, you can't stress the liquidity provider out of to your point, right? There needs to be a market to be able to get out of that position and get into that position. But we're excited to see the geographical diversity, maybe see the benefit of the GTH session and the curb session, and really see where we go with products that are tradable, given how much volume is really in that segment on the weekly side.
Yeah, and I think it's not just like growth for the sake of growth. And when you look at how you evaluate some companies out there when they report out earnings, is the growth profitable, or are you growing into a smaller margin or shrinking margin space? For us as an industry, it's thoughtful growth, and I look at it as, I guess if you're just going by hard-coded rules, we should have been doing AMC options on daily expirations. But then it goes away and it's disappeared. Yeah. And if you look at it, like I said, OCC data, single name options are actually declining year over year, while you're seeing ETF and index increasing. And so are we going to try and grow by, I think new products is how a lot of people are hard-coded thinking about growing. But are we going to try and do that by creating something that was cool in 2020, 2021, but now single names are coming in? And so it's thinking about, are we just trying to go like, okay, hey, here's where they're at, let's grow, let's put something there that they'll bite on? Because when they go away, now you kind of have either a thinly traded product, kind of like a phantom ship that's just floating out there that no one's really using. It is getting something out there that you're going to put out that really addresses a need out there that nothing addresses at the moment. I think that's the thoughtful growth. And that's why for us, we would prefer we grow through getting clients from doing just taking shots at out-of-the-money calls to doing, selling put spreads or buying at-the-money call spreads or whatever that might be. that's growth, and it's growth that makes sense.
Thanks. I'm going to pause there if there's any questions in the audience. Otherwise, I'm going to rapid fire some at you guys.
You need the crystal ball.
Crystal ball questions.
Yeah.
Okay.
All right. Short answers.
All right.
Retail percentage of the market in 2023.
I would say
I'm going to write these down.
I would say we'll go mid 20%. Yeah, don't hold me to that.
Tom?
What was it on the slide the other day? 50% was from retail. Let's go 35.
40.
ADV in 2022. Just go back the other way.
I'm going to say flat.
Slightly down, 37.5.
Yeah, I would say 35 to
tight
37
range.
million a day.
We're going to bring all these back
Sure.
next year and see
Put
how
them
you
up
do.
in big font. We'll see how we do.
Yeah.
2023 ADV.
I'm going to maintain the flat posture. Yeah.
38 to 40.
I'm kind of on the same page as you. I think it's going to be more interesting if you're looking at the flow, though.
Short
Retail
answers.
to institutional, that's what we're going to have to
I mean, I'm a glass half full guy, but, things are normalizing.
Yeah.
All right. Biggest factor supporting continued growth. Tommy, we'll start with you.
Now, in my opinion, well, I guess it has to be short. Education and the right product ad for the right scalable
You
reach.
guys don't know how to keep short.
No, that's why we're up here.
Yeah, I think liquidity and just capital formation for the marketplace.
I think just more experience from new investors.
All right, last one. Where is OIC going to be next year?
Puerto Rico. Let's get that one done, right?
I'm going to say Denver, just from our new friend in the back.
Oh, yeah.
The-
He's got a koi pond or something in his backyard.
Puerto Rico would be nice. Get out there and do a little extended vacation would be great.
Yeah, maybe it'll be a little less hot.
Yeah.
Hopefully.
Yeah. All right, well, thank you guys. This has been
Thank
great.
you.
Thank all of you.
Well, we hope you enjoyed this year's Options Industry Conference. Be sure to keep yourself tapped into the community and keep your momentum going that you've created over the last few days. Safe travels. Until next time, I'm Glenn Thayer.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's MIXLR.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.